a lot of people who are less astute than you would say, how long would it take to go to cash? And the answer is going to cash. We don't go to cash, and going to cash under almost all circumstances is stupid. Because, among other things, when you go to cash, you have to be right away. Because if you go to cash and prices keep going up for a while, as they invariably will, and returns continue to be positive, you fall so far behind by being in cash that you may even jeopardize your business to stay in business.
The cardinal sin of investing in 2025 isn't taking too much risk. It's taking too little. When legendary investor Howard Marks, the co-founder of Oaktree Capital Management with over $180 billion under management, warns that holding cash could be your financial downfall, smart money listens. In an era where inflation silently erodes purchasing power and opportunity costs mount by the day, the traditional safety blanket of cash reserves might actually be the riskiest position in your portfolio. You've diligently saved $100,000, parking it safely in your bank account, believing you're making the prudent choice. Fast forward 12 months, and while you've avoided market volatility, your purchasing power has quietly evaporated by 3 to 5%. Meanwhile, those who understood Marx's philosophy have seen their wealth compound. This isn't just about missing gains. It's about the hidden destruction of value that occurs when money sits idle in an inflationary environment. Howard Marks didn't build his reputation by following conventional wisdom. The man who predicted the dot-com bubble burst and navigated the 2008 financial crisis with remarkable foresight now sees a different kind of danger lurking in portfolios worldwide: the cash trap. His latest insights reveal why 2025 might be the year when playing it safe becomes the most dangerous game of all. Howard Marks approaches cash holdings with the precision of a chess grandmaster. To him, cash isn't just currency, it's optionality with a cost. Cash is not king, Marks often emphasizes. It's a serf to inflation and a slave to opportunity cost. His investment philosophy, detailed in countless memos that Wall Street traders treat like scripture, consistently warns against the illusion of safety that cash provides.
Company profits are more volatile because companies are leveraged, operating and financial, but market prices do this because they're driven by people, by people's emotion, by what we call human nature. And so to figure out when things are going to happen, you would have to be able to predict emotion.
But Marx points to something more insidious than headline inflation: asset price inflation. While consumer prices might show moderate increases, the cost of productive assets, stocks, real estate, businesses continues to climb at rates that far exceed cash returns. This creates a widening gap between those who own assets and those who own currency, a gap that becomes increasingly difficult to bridge over time. Consider the mathematics of destruction. With inflation at 3% and bank savings rates at 0.5%, cash holders face a real return of negative 2.5% annually. Over a 5-year period, this seemingly small gap compounds to a 13% loss in purchasing power. For retirees or conservative investors holding substantial cash reserves, this silent erosion can derail decades of careful planning. While inflation represents the visible enemy of cash, Marx identifies opportunity cost as the invisible destroyer, often more devastating but rarely calculated. In 2025's dynamic market environment, the cost of not investing can dwarf the risk of investing poorly. Marx illustrates this through what he calls the asymmetry of regret, the pain of losing money in an investment versus the pain of missing a generational opportunity. The psychological aspect compounds this problem. Cash holders often wait for the perfect entry point, a moment of clarity that rarely arrives. Markets climb walls of worry, and those waiting for certainty often find themselves perpetually sidelined. Marx's research shows that investors who maintain high cash positions typically underperform not just in bull markets, but over complete market cycles. Marx's strategic alternatives to cash. Understanding the cash trap is only half the battle. Marks provides a roadmap for strategic alternatives that preserve liquidity while combating wealth erosion. His approach isn't about abandoning caution, but about intelligent risk-taking that acknowledges modern market realities. First, Marks advocates a barbell strategy in fixed income, combining short-term treasury bills with select high-yield opportunities. This provides liquidity while capturing additional yield, turning dead money into productive capital. In 2025's rate environment, even modest yield enhancement dramatically improves real returns. Second, he champions dividend-paying equities as cash alternatives. Companies with long dividend growth histories offer inflation protection that cash cannot provide. These bond proxies deliver current income plus upside potential, a combination cash inherently lacks. Most importantly, Marks emphasizes opportunistic funds, vehicles designed to deploy capital quickly during dislocations. Rather than holding cash awaiting opportunities, investors can participate in funds maintaining dry powder professionally, ready to strike when markets present compelling valuations. In 2025's inflationary environment, Marks particularly emphasizes real assets as superior cash alternatives. Real estate, commodities, and infrastructure investments offer intrinsic value that paper currency cannot match. These assets preserve wealth while appreciating during inflationary periods, providing the double benefit of protection and growth. Tactical cash management for 2025. While warning against excessive cash holdings, Marks doesn't advocate zero cash positions. Instead, he prescribes tactical cash management, maintaining necessary liquidity while minimizing opportunity costs. His framework includes the 3 to 6 month rule. Maintain only enough cash for near-term expenses and emergencies. Ladder short-term instruments. Use treasury bills, high-yield savings accounts, and money market funds, maximizing returns on necessary cash. Establish credit facilities. Replace cash reserves with available credit lines for true emergencies. Systematic deployment. Create rules-based systems putting excess cash to work. This tactical approach transforms cash from static position to dynamic tool, ready for deployment when opportunities arise, but never sitting idle long enough to suffer significant erosion. Marks delves into psychological factors driving cash hoarding, identifying fear as the primary culprit. The 2008 crisis and 2020 pandemic created generational trauma, manifesting as excessive risk aversion. However, Marks argues fighting the last war often leads to missing the next opportunity. Cash comfort is largely illusory, a psychological security blanket providing emotional relief at tremendous financial cost. Marks encourages confronting biases directly. Is temporary comfort worth permanent purchasing power loss? Historical examples reinforce Marks' warnings. During the 1970s inflation, cash holders saw wealth decimated while real asset owners prospered. Japan's 1990s experience shows how excessive cash reserves become cultural handicaps, limiting growth for decades. Post-2008 demonstrated excessive caution's cost. Investors remaining in cash, waiting for the next shoe to drop, missed history's great bull market. Those following Marks' gradual deployment philosophy significantly outperformed. Marks's 2025 warning resonates urgently. Traditional cash safety guarantees wealth erosion. The path requires calculated courage, accepting appropriate risks. Marks champions thoughtful capital deployment into productive assets, preserving and growing wealth in inflationary environments. The choice is stark: accept guaranteed cash losses or embrace uncertain but potentially rewarding active investment. As Marks says, the biggest risk is not taking any risk. In 2025, holding cash isn't playing safe, it's playing with fire.